So dear friends, we are discussing the fundamentals of base erosion and profit shifting and action plans recommended by OECD. Okay, I have ignored action plan 2. Action plan 2 we will do in question and answer. That is not, you can say one of the core action plan, and India has not done anything about it. So I have ignored, but there is one question in our Q&A series which will touch upon the action plan which was done for mismatch. Okay, so that we will discuss fiscal mismatch, what is the concept of mismatch and all. Right now let's focus on action plan 3, which is again little important from Indian perspective, that I will discuss now. Strengthen the controlled foreign corporation rules. Please understand, strengthen means if you are already having, then you should make it more strict, and if you are not having a controlled foreign corporation rules, then obviously you have to introduce it in your Indian income tax law, or your income, for every country in their income tax law they should have this. So what is this CFC or controlled foreign corporations? Please understand, if this is India and this is some kind of country, maybe Netherlands, okay, what they do, they will do whole business in India. Please understand, they will do whole business in India, and from India they will earn huge profit, and that profit they will keep in their balance sheet as a reserves and surplus. So they will not distribute that particular profit. Okay, so they will just keep accumulating the profit, because they know that if they distribute the profit, it will become taxable in the hands of the holder. They will do some other transaction, some other way of, through some other way they may distribute the profit, but not directly in form of dividend. So whenever they are having controlled foreign corporations, they will keep the controlled foreign corporation in tax haven. Again, this controlled foreign corporation will be in tax haven where tax rates are very low, and they will not bring that profit to India, even though they wish to bring profit in India. So in India also they are having a subsidiary company, and their holding company is outside India. Okay, so they know that they have to bring the profit in India, or they are having holding company in India and subsidiary company in foreign. So the foreign company is earning good amount of profit. Another example is, one thing is that Indian companies are earning the profit, and this profit is shifted to the foreign country, and then they are not bringing it again back to India. This is one example. Another example is, in India we are having holding company, please understand, and my subsidiary company is located outside India, and this subsidiary company, by doing business in that country, has earned a huge amount of profit. But the subsidiary company, if they bring or if they distribute reserves and surplus to Indian entity, in India the dividend earned from the foreign entity will become taxable, because India treats 100% holding company and subsidiary company also a separate entity. Forget about 51%. Even if it is a 100% holding company, still we consider it as a separate entity, and then dividend received from foreign country will become taxable in India. So what these companies will do, they will not distribute the profit. So what India has done to tackle this particular provisions? First of all, India has not adopted any CFC rules so far, which are recommended by the OECD, but we have introduced one section, and that is section 115 BBD. It is not a control mechanism, but it is an encouragement mechanism, which says, okay, if you are a holding company, or you are a company which is holding more than 26% in the foreign corporation, please ask that foreign corporation to declare the dividend, so that India will get foreign exchange reserve. We will get of dollars in India. That is good for economy, that is good for you. And we will apply the tax rate, which are very much concessional, only 15% tax rate. You don't have to be worried about 30-35% tax rate. Only 15% you pay and bring the profit into India. So one of the way we have taken care of it. But there are so many things that can be done according to OECD, but we have not adopted those plans till now. Look at the OECD recommendation. Controlled foreign corporations are foreign subsidiaries. Okay, so India, we are having holding company in the tax havens. Obviously, the subsidiary companies will be in tax havens, which the taxpayer has controlling interest. Since tax is generally levied on distributed dividend, the tax in the parent country could be avoided until the tax haven country actually paid dividend to the shareholders. So obviously they will delay the dividend. The OECD regards controlled foreign corporation rules as important in tackling BEPS, base erosion and profit shifting, and has made series of best practice recommendation in relation to building blocks of effective CFC regime. Look at this. What are the building blocks? Building blocks means what type of law you should make to bring that particular foreign profits in India and have a better control over foreign subsidiaries. Definition of CFC and control. So you should bring the definition of CFC. That means you should introduce this concept in your domestic tax law. CFC exemption and threshold requirements. Definition of CFC income. What type of income will be there? Next, rules for computing CFC income. Rules for attributing CFC income. And rules to prevent elimination of double taxation. There should not be double taxation because this country is earning income, my subsidiary company is earning income in foreign country, and that income will come to India, and again if it becomes taxable in India, so this particular double taxation may arise. To avoid double taxation, you should bring the rules. So do we have any particular provision of CFC in India? Do we have the concept of CFC in Indian Income Tax Law? So answer is no. There are no CFC rules in Indian Income Tax Act. However, section 115 BBD has been inserted in Income Tax Act 1961 to encourage, so we are not putting pressure on them, but we are encouraging them, encourage a repartition of profits by the Indian companies which have significant voting power in foreign companies. So we are not saying controlled, but we are saying significant, and significant means 26% plus. So tax on dividend received by Indian company from the foreign company. So this is what we have already discussed in income from other sources long back, but I assume that you have already forgotten it. So let's revise this. Does Indian company holds 26% or more nominal value of share capital in the foreign company? If answer is yes, then dividend received is taxable at the rate of 15% under section 115 BBD, and if not, then it will be taxable at the rate of 22% or 25% or 30%. 22% when the company adopts 115 BAB or BAA section, the concessional alternative tax regime. 25% when your turnover 2 years back is less than 400 crore, and 30% in all other general cases. Obviously, these are the Indian tax rates. Okay. So generally you can say tax rates are very high, but if you have 26% holding, the tax rate is very much concessional, 26% only. But because we are giving you concessional rate, obviously it will be taxed on the gross basis. No deduction will be allowed in computing dividend income. Here, interest expenditure is allowable under section 57. If you remember the section 57, interest expenditures, if you have taken the loan and invested in subsidiary company, then interest expenditure is allowed as the deduction, but to the maximum extent of 20% of dividend. Okay. Deduction is allowed in respect of the dividend received from the foreign company subject to the maximum of dividend distributed in Indian company. That is section ATM. They are talking about section ATM because you are receiving dividend from the foreign country and then you are again distributing dividend to your Indian shareholders. So the dividend once received by the holding company will become taxable, and again it is distributed by Indian company to the shareholders in India, that will also become taxable. So there should not be double taxation. To avoid the double taxation, we are having ATM section in our syllabus, which says dividend received or dividend paid, whichever is lower. Dividend received or dividend paid, whichever is lower. This dividend has to be paid on or before filing of return or due date of return, whichever is earlier. Then we will consider, and whichever is lower will be allowed as a deduction in India. So this is the action plan number 3. Please read this and please study 115 BBD if you have forgotten. In fact, this is a good opportunity for all of you to revise whole dividend taxation. Okay, it will take hardly 10 to 15 minutes. After completion of video, please revise dividend taxation to complete the whole process. This is how we have to study. So you can observe in first 2 action plan what we have discussed so far. We are not learning anything new. We are just saying, okay, this was recommended by OECD and this is what we have done. So whatever we have already done in India is taught to you. You are already aware of that. I'm just linking OECD action plan and law which is applied by Indian government. Thank you.